You're pre-approved to buy a $600,000 house, but should you spend that much? Or maybe you're wondering why you're only pre-approved to $400,000 when you make good income. In this video, I'll talk about how lenders calculate how much you can afford and qualify, and then I'll also give you some tips on how to do it yourself. Your debt to income ratio, or what lenders will refer to as DTI. It is the #1 factor that lets a lender know how much house it is that you can qualify for and how much house you can buy. Essentially, it's your monthly debt divided by your gross income. And there are two different types of debt to income ratios, or DTIs, that lenders are looking at. Your front end ratio, or your housing ratio, is going to consist of your proposed principal and interest, property taxes, homeowners insurance, and any type of HOA dues if there are any, and what lenders will refer to as PITIA. Most loan programs want this ratio to be anywhere from 30 to 40%. With FHA, it actually tops out at 47% for the front end ratio. Now, the second ratio is your back end ratio. This is the actual ratio that lenders are going to use to see how much house you can qualify for and buy. And basically what it consists of is that first ratio, the front end ratio, and now it's also going to include any liabilities, so any debts that show up on your credit report. We're talking credit cards, student loans, personal loans, auto loans. However, it doesn't include any utilities that would show up on your credit report. Sometimes utilities can show up on your credit report if you have the bureaus designate them there, and that's to boost your credit score. However, these are not counted in the ratios and they're left out. When we're talking about different loan programs and their debt to income ratio requirements, they are going to be different between different loan types. For example, FHA allows you to have a 56.99% back-end debt to income ratio. This is going to be a little bit higher than you're allowed on a conventional, but it's the most flexible and is good for borrowers that have some more debt. Conventional, on the other hand, allows 49.99% as the maximum back-end debt ratio, but this requires some cash reserves and a strong credit score. So typically for conventional, you're going to be around 45% and still qualify. VA loans are actually going to be the most lenient when it comes to debt to income ratio. They don't actually have a specific number that you have to be at. As long as the automated underwriting system reads the entire credit profile as a whole, you have some income reserves left over, and you have some cash reserves. I've seen debt to income ratio at 65% and still been able to approve veterans for their home loans. The key part with VA is going to be the residual income. Residual income is going to be the income that's left over for you after your proposed mortgage payment and your liabilities that get calculated into the DTI. The money that's left over is going to be that residual income. If you have a good amount of residual income, then the likelihood of you taking your debt to income ratio higher, maybe in the 60 or 65%, is better. USDA loans are going to max out on their debt to income ratio at 43%. In some cases, you can go higher, but most lenders are going to have an overlay saying that 43% is going to be the highest debt to income ratio that you can have. If you do go higher than the 43%, or if there's a lender that allows you to go higher than 43% for this USDA, you're more likely going to need some compensating factors like cash reserves, a strong credit score, and residual income. So let's do some quick math here on how to calculate your debt to income ratio. We'll use somebody who makes $100,000 a year. If we divide that by 12, it's $8,333 a month. If we're talking about FHA and we're going to 56.99% on the back end debt ratio, $4,749 is going to be where you're going to be maxed out for the proposed mortgage payment and any liabilities that show up on your credit report. But let's say that you have some debt, and most people are going to have some debt in the form of either credit cards, auto loans, personal loans, maybe even student loans. So these are going to be factored into that debt to income ratio calculation. For example, let's say your car payment is $500. You have a small credit card payment for $50 a month, and then you have a student loan for $150 a month. That's going to leave you with $4,049 for your proposed mortgage payment. and that's going to help the lender calculate how much house it is that you can buy. So basically, the highest mortgage payment or proposed mortgage payment that you can have is $4,049. And like I said previously, that's going to include the principal and interest, taxes and insurance, and then any kind of HOA dues if there are any. But just because you qualify on paper with a lender for a specific purchase price, does that mean that you should buy a house for that much? This is where you're going to basically play a balancing act between your current expenses, which don't show up on your credit report. The lender can't see all of your expenses that you have on a day-to-day basis or a month-to-month basis. We can only see whatever shows up on the credit report. So you will know your budget better than a lender will. And then you and your lender will use that budget, use that number that you're comfortable with, and then from there, start putting you on a search to purchase homes that are within that range. So here are some tips for increasing your affordability or your qualification. If you're not qualifying for as much house as you would like, there are some things that you can do and that you can work on. Might take a little bit of time, but there are some things that you can work on to increase that affordability. You can pay down or eliminate debt. You can improve your FICO score to qualify for lower interest rates and lower costs. And you can add a co-borrower to the loan. Also, you can consider buying in areas that have lower property taxes, because this is going to be factored into that debt to income ratio. If you're buying in a newer area, property taxes tend to be higher, and there are special assessments with newer homes. And basically what those special assessments do is they help develop the current neighborhood or the current area, because a newer home isn't going to have as many amenities as a home that's been around for 20, 30 years. So now that you understand how much home it is you can afford and you understand debt to income ratio, check out my next video that will go into conventional versus FHA to see which option is going to be better for you. If this video helped clear up any confusion or was helpful, please do me a favor and hit the like and subscribe buttons. And if you'd like a free consultation, use the link in the description and you can set up a Zoom call with me.